this is Ken from Capital Advantage Tutoring, coming to you live from the shores of the Mekahai-Mekahine-Ho Island. We're going to talk about investment vehicles now. So if you do them right, you can end up here spending your golden years lying on the beach. I don't go on the beach too much because really, if I get too close to the water, they start shooting harpoons at me. Let's get on this. Okay, we're back in, all dried off and everything. No nudity. We don't like that. Not for me, because that would scare the shit out of people. So here's the deal. We're investing, right? So we want to worry about investment vehicles like securities, stuff we're going to invest in. This could be a longer video. If it's really long, I'll probably break it into two, but we can get into this and start talking about the investment vehicles. Now, another way to do this is if you go to my SIE exam playlist, we'll try to put a link up here because I'm not speaking normal. I'm going to try to link it right up here. What we'll do is you can go through that and get the vehicles, not the insurance stuff, but we'll get there. So we're going to go through a lot of stuff like mutual funds, stocks, bonds, high level stuff. You should have an idea of this. If you're taking the 66, you should be good on most of this already, but it's good to go in a deeper dive. If you're doing the 65, this might be the first time you're hearing it. I would still say then go to my Series 7 playlist, run like chapters 5 through 9, videos 4 through 9, and go from there and see how it goes. So let's get into some of this shit. Okay, so let's start with common stock. What's common stock? Common stock is ownership in the company, right? So you're buying stock, you're buying shares of the company. Again, you should be watching my videos in this. So I'm going to give you the high level stuff. You buy common stock for either growth or income or inflation protection. Your ownership, what do you have to do? You have the right to vote on certain things like, I can't even think of the word, stock splits. You have the right to vote on board of directors, important shit like mergers and takeovers, but you can't vote on dividends, right? Now, how do we get dividends? There's two ways we get dividends. There's actually a bunch of ways. So I don't know why I said two. One is cash. Cash dividend, you get cash. Now remember, when you get a cash dividend, you pay taxes on it the year you got it. There's no deferring of it. Even if you automatically reinvest, you are paying taxes on that shit. Okay. So that's a cash dividend. You can also get a stock dividend. It's like a little mini split. You're getting more shares. But remember, whenever there's a dividend, it's a zero value thing. So there's zero value change. So if you have 100 shares at 50 and you get a $1 dividend, they're going to drop the price to 49. So there's no good or bad. Same thing with the stock dividend. If you have 100 shares at 50 and you got a 10% stock dividend, you're going to get 10 shares. You now have 110, but it's worth 45.45. So that would be the same amount. There's no up or down on that. The good thing about a stock dividend, you don't pay taxes on it now. You actually pay taxes on it when you actually sell the shares at your capital gains rate. And if it's more than a year, if it's qualified, more than a year, it's at your long-term gate rate. And if you do it short-term, sell quick, then it's under a year or less, it's going to be a short-term capital gain, which is very similar to your ordinary income rate, which kind of sucks. So that's why you buy common stock. One of the reasons is for dividends, okay? Now, you can also get product, which is just nobody ever does that. But like I always joked, I bought Playboy stock when I was 16. I was hoping, but never got it. The annual report was awesome, but I never got any such a Playboy. Remember, this is pre-internet. 15-year-old boys weren't getting anything. They weren't seeing anything. It was like National Geographic is what we went after. Okay. Now, that's common stock. You buy it for growth, which means capital appreciation. You're hoping it goes up. Now, let's talk about this real quick. Let's bring a couple things into it. When people analyze these stocks, they look at either technical or fundamental, right? Tactical means they're looking at charts, trends, patterns to decide when to buy or sell the stock. Technical doesn't really work on bonds and stuff, maybe with interest rates, but not with the pricing of the bonds. But it does work on stock. They have support, resistance. We have support, resistance, overbought, oversold. All those things are technical trading. Think of technical as trading. They're not looking at the stock. They're looking at the patterns. Then we have fundamental, where they rip apart the company, right? They look at the balance sheets, the income statement, two different things. What's on the balance sheet? Assets and liabilities. What's in the income statement? The money going in and out, stuff like that. Now, there's a couple ratios that we use. Earnings per share is the earnings divided by the number of outstanding shares. Remember, we're fucking morons. So we always have to have this shit spelled out for us. So EPS is earnings divided by the number of outstanding shares. Outstanding shares. Now, another thing they will ask you on these exams is PE ratio, price to earnings, to determining is this stock overvalued, undervalued, is it a growth stock, is it a value stock, stuff like that. So PE ratio, again, morons, is PE, price over earnings. So it's going to be market price over earnings, not earnings growth, earnings. Price over earnings growth is called the PEG ratio. Don't look it up. PEG ratio is price over earnings growth. They're not going to ask that, but I've seen that as an answer on a test, okay? P ratio is price over earnings. And if it's a high PE, it's a growth company, usually comes with a low dividend, high retained earnings, and a low PE is usually a value stock, high dividend, and a low retained earnings. Ken, what's retained earnings? Retained earnings is the amount of money that they don't kick out in dividends. Okay. So that's kind of what they look at with common stock. That's how they evaluate it sometimes. So we're built into that. Now, so you're either going to buy it for growth or income, right? Growth is capital appreciation. You buy it here, it goes up, you sell it for more, you have growth. The other one is income, that's the dividends. The third reason, inflation protection. There is not, other than like gold, common stock is the best over the long haul, is the best inflation fighting tool there is. So think about it. Other than the 2021s, right? Okay, maybe 2022, inflation's around 2-3% max every year, other than the outliers. So if it goes up, prices go up every 2-3% every year, stocks go up around every 10%. So you're kicking the shit out of it. So you're buying common stock to kick the shit out of inflation. So that's what it is. Also, remember, common stock is much more about long-term than short-term. I would say anything under 5 years, you kind of stay away from equity. Real world, I talk to the traders and the FAs, they call me nuts, but I go, look, I'm not talking about real world, I'm talking about test world. Anything under 5 years, you kind of lean toward the bonds and the muni and the money markets, not common stock. So that's common stock. But remember, the dividends can go up and down. You don't know what they're going to be. So if I want a more consistent dividend, a type of fixed income, I'm going to buy a preferred stock. Preferred stock is equity. You have almost none of the rights that common has, other than you get paid before common. Now, they have a fixed dividend. So if you buy a 5% preferred, you're going to get 5% of par of 100 normally. So you're going to get $5 a year. That's usually once a quarter they pay. They could do semi-annual or monthly, whatever, but let's go with quarterly. So if you get $5, that means you're going to get $1.25 every, well, $1.25 every quarter. Okay, you're going to get $1.25 every quarter, and you're doing that every year, and you're buying that for income. So it's a fixed income. Since it's a fixed income, it acts like a bond. It has interest rate. It has reinvestment risk. What's reinvestment risk? Reinvestment risk is the fact that you're going to get paid, and you have to reinvest that money. And if the rates are lower now than they were before, when you were getting it, you're going to reinvest at a lower rate, or your total return is going to be a little less. So that's reinvestment risk. That happens when rates go down. When rates go up, we have interest rate risk, because if rates go up, your thing's still paying 5%. So the fact that new preferred and bonds, same thing, are coming out at like 6-7%, you're still getting 5%. Yours is way less attractive, so the price drops. That's interest rate risk. We have call risk, the fact that they're going to call it. Okay. You have inflation risk, because every time you have a fixed income, remember, that's why fixed income isn't great for long term, because inflation beats it, right? So if you're getting 5% a year, but prices are going up 2% every year, you start losing to inflation. So over the short term, fixed income doesn't have a lot of inflation risk, but longer ones do. Okay. So that's preferreds. Okay. There are different types. There's cumulative preferred. So if they miss a dividend, because remember something, dividends are never guaranteed, right? So if you miss a dividend, okay, and then you go to the new year, you don't actually owe it anymore, because it's kind of like, hey, we don't have to pay you. But you can't pay the common until the preferred is fully paid for that year. So if you just get through the new year, then you don't owe anything. You can pay the common and the preferred. But they have a thing called cumulative preferred, which means even if you miss the last 4 years dividends, cumulative, you have to pay all that before you can pay the common. So that's going to lower your return a little bit, because you're taking on less risk. Remember that. The more risk you take, the more rewards you should get. The less risk you take, the less rewards you're going to get. So if I have a regular preferred, it may be hitting at 5-6%. If I make it cumulative, maybe it's 4-4.5. Another one is called participating, where if the company gets more money, has a good year, they'll bump your dividend just for that quarter or whatever it is. The next one is convertible, which is great. I love convertible ones. They turn into common stock. Remember, anything that turns into something else is pretty much always turning into common stock. Okay. So a convertible, preferred or bond, you buy it, it gets an interest rate, right? But low, because it's very attractive, very low coupon. And you're gonna get the growth portion too. Because if you have this that turns into this, they're gonna move together. So if the stock goes up, the preferred, convertible, preferred, or bond will go up with it. So convertibles will have a lower coupon, but they have income, which is from the preferred dividends, or even if it's a bond, the interest. But they also have the capital appreciation or growth portion, because it's going to follow the stock. Kind of the best of both worlds. If I buy preferreds, those are the ones I'm buying. Or if I buy bonds, I'm buying convertibles, because I'd rather have the growth portion plus the income. So you get both. Now, Again, you buy for income. Preferred and bonds, fixed income, you buy for current income. That's the deal. Okay. Now, if you want a higher return, maybe you do the preferred. If you want a lower return, you do bonds. Why? Because bonds are actually secured by assets, or the company maybe it's promised, but there's a contract saying we have to pay it. Whereas if and wherefore, therefore, a preferred, it's just like, yeah, we're probably going to pay you, but you really, if we don't, there's not much you can do. So preferred has a higher coupon, more risk. So again, more risk, more reward. Theme on this test, okay? More risk, more reward. Less risk, less reward. So common is equity. You get to vote, and you have a lot more movement. Preferred is more like fixed income. So it really only moves when interest rates move, unless it's convertible, and then it does move with both. Okay. Now, moving on to that, let's say I want to invest outside the country. Maybe I do an ADR. An ADR is representative of a foreign security. So let's say you wanted to buy Nestle out in Switzerland, right? Okay, I think they're even moving. But let's say you want to buy Nestle out of Switzerland. But you're not gonna open a brokerage account in Switzerland, get an account there, and then buy it. What you do is you find out like a UBS or a Bank of America or somebody buys the shares of Nestle in Switzerland, right? And then they package it, and then you buy shares of the package. Okay, you can't even see this. Ooh, it's like it's a magic trick. It disappeared. This time it didn't work. So I'll hold it here so it doesn't go. So this is a package. This thing has a lot of securities in it, like Nestle, and then you're buying this thing. You're buying the package. This is called an ADR. So the ADR is a U.S. security. Remember that. The ADR is a U.S. security, but it's holding foreign securities. So it's like buying a foreign security without going into another country. Why you would do this? To diversify, right? To kind of diversify outside your just U.S. Go America, U.S. stuff. You want to buy some shit from other countries just to increase your return a little bit. Because remember, more risk, more reward. Now, what if you want more secure income? Maybe you're willing to take a little less income to be more secure. You would buy some sort of bonds, right? A bond is literally this. We should know this already. I'm a company, Catch Tutoring right here. I issue a bond. You're going to buy it. You're going to lend me $1,000. I'm going to pay you, say, $50 a year for 20, 30 years, and then I give you your money back. You're lending me the money. So that's a fixed income. Now, it can come two different ways. I'm going to pay you every 6 months. We got that. That's usually the way it works. I'm going to pay you $50 every year, but it's going to be 25 and 25. Every 6 months, I pay you $25. That's your current income. Okay. Now, the reason it has a lower coupon than preferred. So if I issued a preferred and a bond, my bond would have a lower coupon than the preferred because there's less risk. Because remember, I signed a contract that I owe that to you. It's money owed to you. So if I miss a payment, you can actually sue me, or really the trustee will do it on your behalf. But I have a problem if I don't pay it. Whereas preferred, if I don't pay it, you shake your head at me and there's not much you can do. Just be like, hey, I want my money. And you go, I'm with you. I got you. I'll take care of it. And then nothing happens. So bonds have a contract that I have to pay. Preferreds don't. Now, we don't have to go too deep in it, but remember, corporate bonds are what they call non-exempt, which means they have to register pretty much everywhere, unless they're one of that list of exempt securities I give you. And they pay taxes on every level on the interest. Treasuries are backed by the government. T-bills are short-term. T-notes are 2 to 10. T-bonds are up to 30 years. TIPS are treasury inflation, which you may have to do the math on that, okay? And I have videos on that. And then strips are long-term zero coupons. What is a zero coupon? A zero coupon is a bond that you buy at a discount, and then it grows. You don't get anything to the life. You get your money at the end, right? So let's say I buy a 10-year strip. It matures at 1,000. I buy it for like $850, maybe $800, and then at the end of 10 years, I'll get the 1,000. That $200 is considered my interest, but I get nothing during the life of it. Although the IRS goes, we want to accrete it. So they're going to make me pay a little bit each year. You don't have to do the math on this test, right? On either of these exams. Series 7, yes. 65, 66, no. So if I buy it at 800 and it matures in 10 years at 1,000, they're going to say, oh, we think it goes up $20 a year. So they're going to accrete it and make me pay taxes on that $20 each year. So I would normally put like a zero coupon, maybe in an IRA or a retirement account, so I don't pay taxes on it because it's tax deferred. So that's the start of bonds. So we have corporate, which is taxable on every level, treasuries, which are taxable on the federal level only, and then you don't pay state tax. So always remember, entities tax themselves. And then we have munis for rich people. Remember, rich people buy munis, poor people buy corporates, wimps buy treasuries. So munis are for rich people. If you have a high income, high. If you're living on Social Security, you're not buying fucking munis. So the top end. So understand, this is the stat I say to everyone. What percentage of the country pays 0 federal taxes? Oh, wait. Almost 50%. The bottom 50% of the country pays no federal taxes. They pay state and local, all that shit, but they pay no federal. So they would never buy munis because why would you? There's no reason for it. So it's more like people have a lot of money buy munis because it's federally tax free. And if you buy it in your own state, it's fully tax free. Also, treasuries and munis are exempt. Neither one of them register on the state level or with the SEC. But again, you're buying munis for tax free income. That's the thing. So if they don't say rich or tax is a thing, you don't really go to munis because remember, low risk, right? So munis, since they have no taxes on them, they're very attractive. The coupons are very low. So keep that in mind. Munis have a very low coupon because they're tax free on the federal level. They can offer a lower return. That's better for the investor. Keep that in mind. Now, don't go crazy in this. Understand we have the bond triangle. I'll put it here, but let me throw it up here. Okay, so this will help a little bit with the bonds because you're going to get a couple questions about interest rates, yield to call, stuff like that. So I've done the bond triangle. I have videos on this, but here we go. So if it's a discount bond, remember, coupons are lowest, goes coupon, then current, then yield to maturity, then yield to call. Coupon, then current, then yield to maturity, yield to call. That's from low to high. That's a discount. So if you have a discount bond and the coupon, if you see a yield that's higher than the coupon, must be a fucking discount, okay? If you see it the other way, it's a premium. Coupons are highest, then current, then yield to maturity, then yield to call. So if you see coupon is the highest yield and the other ones are lower, then it has to be a premium. Hope that helps. And then remember, a par bond, all yields are the same. They're not going to make you ever figure out yield to maturity or yield to call, but you need to know that on a premium, they're lower. You need to know the order. But look, it's the same thing. Coupon, current, yield to maturity, yield to call. Coupon, current, yield to maturity, yield to call. Okay. Now, and then this one, coupon, current, yield to maturity, yield to call. It's the same order. But this is I saw a question. I might have seen a question like this where they did a question. They had a bunch of little stuff, and it was literally that all yields. It was coupon and current and yield to maturity were all the same because there's a bond trading at par. Now, on this note, so when they talk about volatility or duration, right? Duration is how volatile the stock is, the bond is. So remember, long and low, baby, long and low, baby. Long-term bonds move more than short-term bonds. We know that one, okay? And then remember, low coupon or low price moves more than medium or high price. So remember, the lower the coupon, the deeper the discount, the more the bond will fluctuate. So long-term bonds move more than short-term bonds. Low coupon moves more than medium or high, and low price moves more than medium or high. That's price. God forbid they ask you what interest rates move the most. It's the opposite. Okay. I don't think they're doing that. Most of it's going to be along the lines of this. Maybe one volatility question like the 2% moves more than the 5%, which is true. Now, remember something. Sometimes they ask it in a different way. Like we know that the lower coupon is more volatile. So we would know that the 2% is more volatile than the 5. And the same thing is saying the 5 is less volatile than the 2. That's literally the same sentence, just coming at it from a different angle. Okay, so remember the big risks on bonds: default risk, that you lose your money. Interest rate risk, that rates go up, price go down, just like preferred. Reinvestment risk, you get paid, so you're going to reinvest the money, and it might come in at a lower rate. We have call risk, that if the rates drop, the company might call the bonds back and buy them back from you. That's not a good thing. We have inflation risk because anything with inflation, anything with fixed income has inflation risk, right? Now remember, bonds have default risk, preferreds don't. They have business risk really, that they just won't be able to pay you, but they don't owe it to you, so they don't actually, there's no default. Bonds have default risk, they don't. So I think that works. I think that's a good idea on the basics of bonds. You should watch the videos, get a little deeper, but I'm just trying to make sure they have a high level understanding of investment vehicles. Now that we talked about products, let's talk about the actual package products. Products and products. I guess I said the same thing. But we've talked about the stocks, bonds, preferred, stuff like that. Let's get into the package products like mutual funds. You'll definitely get questions on this. So what's a mutual fund? A mutual fund is a package product. It's like, think of this. You can't see it because of the blur, but yeah, right there. You can see this. Stewart here, right? The actual bottle is worth nothing, maybe 50 cents. But what's in it matters. So this is root beer. It's good. But let's say it's filled with securities, right? And the value of the securities inside this will move up and down. You should be pretty much okay with this so far. That's a package product. So when you buy this, if it's a mutual fund or what I call an open-end fund, you're buying it the NAV, the actual value. I have videos that I could probably post here. Maybe I will, maybe I won't. That'll go over the details of this stuff, but let's get into the big stuff. Now, when you buy a mutual fund, you're either gonna go one of four ways, right? So same fund, three different ways. You have Class A, Class B, and Class C. Okay. Class A is a front end load, right? The people at letter A was always on the front of the line. So front end load means you're paying sales charge when you enter the fund. So and the thing is, you get break points, which are volume discounts, which my videos go over. The break points, the more you put in, the less you pay, right? So you put money in. If you're going to put a lot of money in, you get a lot of break points. So, and the fees aren't that bad for the long haul. So Class A is for long-term, lot of money. Long-term, because the ongoing fees are not that bad, and you pay up front when you go in. That's kind of it, okay? Management fees, but no more extra fees on top of that. And you get the break point. So if you put a lot of money in, you pay very low fees going in and not a lot of fees going on. So that's Class A, front end load, long and low, okay? Low fees, long, and a lot of money. Class B, back end. B for back end, or what they call a contingent deferred sales charge. Now remember, you can't call it a no load. You're not paying for the sales charge when you go in, but you may pay when you leave. But the longer you stay in that fund, the less you pay. So class B is back end. It's better for like medium to long term if you don't have a lot of money, because there's no break points. The only way your fee goes down is the longer you hold it in the fund. Every year they drop it by a little bit, and usually around about 5 to 7 years, there's no more sales charge, what they call redemption fee or contingent deferred. What does CDSC mean? Contingent deferred sales charge. It's contingent on how long you stay, and it's deferred to when you leave. They may call it a redemption fee, but either way, it's better for mid to long term if you don't have a lot of money enough to get break points. Class C is no sales charge, okay? There's no sales charge, cannot be called a no load fund, because there's an ongoing thing called the 12B1 fee that all of them charge a little bit, but Class C charges the highest. It's literally you're paying like 1% a year. So it's very much for short-term investing. Class C is for short-term. It cannot be called a no-load because of the 12B1 fee, because of the big 12B1 fee. No-load funds actually have no sales charge, no front or back, but their 12B1 fee is it can't be higher than 0.25% or what they call 25 basis points. So you can have, remember that, a no load can have a 12B1 fee, but it can't be higher than 0.25%. One of the main reasons, there are three reasons to buy a mutual fund. One, liquidity. It's awesome. That's not the number one. It's A1. Second is diversification. It gets rid of non-systematic risk. It does not get rid of systematic, which is market risk, because you always have that, but it reduces non-systematic risk vastly because you're diversifying. I mean, literally, you're buying into a fund and it has like 400, 500, 1,000 securities in here, split up. You're buying a little bit of each. Okay, now, the third reason is for professional management, which I think is overrated, but it's a professional management, some rich man or woman living in Greenwich in a house that's way too big for them, managing your portfolio. Now, their job is to create alpha. Now, I have videos on that too somewhere. You're not going to have to do the math on it, so don't worry about it. But alpha is what you do above what's expected. So let's do a math thing. Say, I'm not going to write it down because you just got to visualize it. Okay. Whoa. If you have an index you have an index, say the S&P 500, minor one, and your beta, which is just a multiplier. Beta is your multiplier, sort of volatility risk. If you have beta is a multiplier. So if you have a beta of 1, you multiply 1 times the index to determine what you're going to do. So if it's 1.5, you're going to do the index times 1.5. So if the index goes up by 10%, and you have a beta of 1, you'll go up 10%. If you have a beta of 1.5, you go up 15, 1.5 times 10. If you have a beta of 2, you go up 20, 10 times 2, okay? Or if you have a beta of 0.5, you're less volatile, more conservative, you'll go up 5%. Again, it's a multiplier. That's your risk-adjusted or expected return. So if the market goes up 10% and you have a beta 1.5, 10 times 1.5 is 15%. That's what you should do. That's what you're expected to do if you're not a moron. If you actually do 17, you did better, right? You expect to do 15, you did 17. That's 2 points of alpha. Now, if you did 13, that's negative alpha. That's bad. Where they're not going to do it on the test, but let's say they do. Let's say the market goes down 10% and you have a beta of 1.5. You should go down 15%. But if you only go down 13, you're doing better, right? You're going down less. That's 2 points of alpha. If you went to 17, you did worse. You have negative alpha. You don't want negative alpha. That gets you fired. Now, what's interesting on mutual funds, one of the things that comes up all the time is tenure. Remember when you're a kid, tenure track was like if the teacher couldn't be fired, right? How long then? Same thing here. Not that they can't be fired, but that's their length. Management tenure is important. It's one of the things you look at to determine if a mutual fund or a fund or portfolio is worth investing in. If they're averaging 15% a year and the manager does a brand new one only 6 months or a year old, that's not him. Okay, her. Okay. So the point is, long tenure is you can gauge what they're tracking. So management tenure is how long the manager has been managing the fund, not how long the fund's been in business, how long the manager has been managing the fund. There's something. Mutual funds have to distribute 90% of their income every year. That's a regulated, right? Okay. Just like REITs, they have to distribute 90% of their income every year. So 4 times a year, they distribute dividends and income. That's taxable. And then once a year, they distribute capital gains, which is pretty much long-term capital gains. Even if you bought the fund yesterday, if you get the distribution, it's a long-term capital gain for you. But remember something, even if you choose to automatically reinvest everything, which most people do, it's still taxable. The IRS considers once you got it, it's gotten, and you're paying taxes on it. So remember, everything about a mutual fund is taxable. If you move from one fund to another fund inside the family, like say you go from large cap to mid cap, okay? You sell your large cap, you buy your mid cap. If you made money on the large cap, like sold it for more than you bought it for, you owe taxes on that. Yes, the mutual fund offers an exchange privilege, which allows you to move it from one fund to another without a sales charge, but the IRS doesn't give a shit. Everything about a mutual fund is taxable. If you get a distribution, taxable in that year. Capital gains, taxable in that year. You sell it for more than you paid for it to move into a new fund, you get taxes that year. So everything about a mutual fund is taxable. There's no such thing as deferred taxes on a mutual fund unless it's actually in a deferred account. Ridiculous freaking PowerPoint. I hate these things. I'm not good at them, but we're going to get it go. So here we go. We have open end, which is known as a mutual fund. We have a closed end. We have an ETF. Then we have an ETN. They're all different things, a lot of similarities, but there's a lot of stuff that's different. So let's get on the first thing. Okay. So open-end funds, mutual funds are actively traded, which means I don't mean that they're traded like the portfolio is traded, not the stock, because you don't trade mutual funds. You buy and sell. You buy and redeem. So what I'm saying here is that the portfolio inside the fund is actively traded. We'll call it actively managed. I call it actively traded. It is what it is. Okay. We'll deal. Actively managed. They're trying to beat the market. They're trying to add alpha. The manager matters. The problem is that causes fees. So the fees are going to be higher. The expenses are going to be higher on the mutual funds because they actually have an active management philosophy. When you buy shares, they're issued and they're redeemed every day. So there's a nonstop issuance of shares. So if you want to buy shares, you're going to buy a dollar amount. You're not going to say, I want 30 shares. You're going to say, oh, I want $3,000 worth or whatever it is. And a lot of them have minimums, right? So they have like a minimum. Maybe you have to put 1,000 in or 2,000 or 3,000 at a time. A lot of them have those minimums. But here we have, we're going to issue. So when you buy shares of a mutual fund, you're buying them actually from the issuer. This is the only one where you're doing that, okay? So you're buying them actually from the issuer, and then when you get rid of them and you pay NAV plus a sales charge, which we'll talk about, and then you redeem them back to the issuer. So when you want to get rid of them, you're going to sell them back to the issuer, not another investor. So they issue every day, and then if you want to get out of your shares, you redeem. So it's like a little mini IPO every single day. So now when you buy into this, you're going to pay the NAV, which is calculated at the end of the day, plus a sales charge, okay? So you're going to pay the NAV, net asset value, plus a sales charge, which maxes out at 8.5%. I don't think any funds do that anymore. And then they have different classes if you want to do it, which I have videos on that, okay? So this is just, again, a way too fast rundown on this shit. So you're going to pay a sales charge of max of 8.5%. And then when you sell it, you probably won't pay any sales charge or any kind of redemption fee because you're paying it up front. Now, mutual funds and other ones have to distribute 90% of their net income. Every year, it's called the conduit theory. They have to distribute 90% of their income. What does that mean? That means they get their money, they make their capital gains or dividends, their income, they pay their bills and all that stuff they have to do. Whatever's left over is their net income. They have to distribute 90% of that to their investors. If they do that, then they only pay tax on the 10% they don't pay. Why is that better for you in a way? Well, then you're getting money that's never been taxed. So instead of being taxed twice like a corporation, it's only taxed once. The problem is every year you own it, you are paying taxes because you're kicking up money. That will pop up later. So again, they're distributing 90% of their income, which you think is good because you're getting paid every year, but you are paying taxes on that. So even if you choose to automatically reinvest the dividends, you are paying taxes on that money as it comes in. The other problem with this is that you don't actually get to see everything they trade. You can't. Obviously, they're trading all day long, in and out, and all that. But you don't see, you see like the top 5, top 10 of their portfolio. You don't see everything they have. So that becomes an issue because like you just got to kind of trust that they're going to do it. Look, they know what they're doing. They're not going to screw you over. But it's like, say you buy the, large macro whatever fund or the U.S. global equity funds. You have an idea of what they're doing, but you won't know the exact securities or what percentages they have in each one. There's really no liquidity risk because really, if you want to sell at the end of the day, the issuer is going to buy it back from you at a fair value, which is the net asset value. That does cause problems because if the market is up in the morning and you go, oh, I want to sell it, and you place the order to sell, you're not selling it, really getting your price till the end of the day, which then the problem here is that what if the market turned at noon? You're getting the lower price now. So there's issues with that. But you are liquid. You will always be able to sell your shares. As I said before, they have an active manager, so there are higher fees, okay? So they actually have higher fees than the other ones, for the most part, because there's an active manager. They have commissions. They have to pay the percentage of assets under management. They have to pay other fees, so that is there. Really, the only risk that you have on this is market risk. You don't have default risk. You don't have any of those risks. You have market risk, the fact that the market will drop, okay? That's the big one, is that the market will drop, and there's really nothing you can do other than maybe buying, inverse ETFs, or which we didn't talk about yet, or buying index puts. That's your really only way to do it. Now, on the other side of this, that's an open end. So we have a closed-end fund, which is very similar, except for it's a closed-end fund. Now we'll get into what it is. So they are actively traded too. Again, what I mean by that is actively managed. I'm probably going to use actively managed instead of actively traded, but I'm too fucking lazy. I'm not changing it. So actively managed, which means the actual portfolio manager is trying to beat the market, buying and selling all day long. Now, the thing with this is how it's different than the open end. They issue shares one time. Boom, they issued them 1 million shares, 100 million, whatever it is. And then if you want to buy shares, you buy them in the market from other people. Okay, I've done videos on this. So it's good to have them all in one shot. So one-time issuance of shares, they trade in the secondary market. If you want to buy the shares, you can buy them in the market. If you want to sell them, you can sell them in the market. But you actually have to find, which isn't that hard, a person who wants to sell them to you or a person who wants to buy them from you. So remember, if you buy an open end, you're buying it from the issuer or underwriter. If you buy a closed end, you're buying it from other people who already own the shares. Now, when you buy or sell the shares, you are paying a commission. Now, that's on both sides. Open end, you pay a sales charge when you enter, probably not on the way out. And on a closed-end fund, you're paying a commission. When you buy it, you pay the market price plus a commission. And when you sell it at the market price minus a commission. When I say minus, I mean they take away from what you're getting, not you getting that. They're supposed to distribute 90% of their income also. So again, it's not so efficient, right? Because you're going to pay taxes every year. You own this shit for a long time. Even if you reinvest, even though there's not really a reinvesting thing here, but even if you decide to rebuy shares with it, okay? If you want to buy shares with your dividends, yeah, you can buy them, but you're going to pay a commission. But either way, you're getting the money, both open end and closed end. You're getting 90% of your income, and you're paying taxes on that as you get it, no matter what you do with the money. So that leads into some ongoing tax practice. Again, low transparency. Just like an open end, you cannot see everything they do. So that's sometimes a problem. They have some liquidity risk because they're not nearly as active in open end or ETFs. That's an issue. So, but the thing is, if you want to sell your shares, you have to find a buyer for them, okay? Which the broker does for you. I mean, it's like buying shares of IBM or whatever it is. You have to find a seller. And if you want to sell your IBM, you have to find a buyer. But that's what the market is all about. So it is market priced based on the last sale and all that stuff. But you do have some liquidity risk because they're not nearly as liquid as mutual funds and ETFs. You have higher fees. Why? Because you're actively managing it, right? Actively, that's going to be my biggest, whatever you want to call it, piss me off that I didn't do that, but it is what it is. People make mistakes. Higher fees because you're actively managing it. There's commissions and all that stuff that they have to pay to keep everything going. And you have market risk. That's your biggest risk. Maybe a little liquidity risk, but for the most part, you have market risk because it's invested in the market. You have a broad one or a narrow, whatever you want, but you're going to have market risk based on the market going up and down. Then we jump over to ETFs. My favorite thing is the ETFs. Okay. ETFs are a packaged product. All of these are packaged products, right?
I'm doing this video knowing that you understand that these are pooled investments, okay? You got to understand that, or back up and do something else. Now, an ETF is a packaged product also, but it is passively traded, managed, okay? Drive me nuts. They really just rebalance once a quarter. So they have a set portfolio of percentages that they have, and then what they try to do is that they try to go out and they don't do anything. They just have the portfolio and they're trying to track an index. So they have a thing called tracking error. So a lot of these things, anything that has a pooled investment has some sort of tracking error because you're trying to track an index and maybe you miss it by a little bit. Close end and open end really don't have it because you're trying to beat the market. But anything that tracks an index, like an index fund, ETN, ETF, has tracking error because you're trying to track and match an index. They're not perfect. There's costs and in margin and salaries and taxes they have to pay. So it won't be exact. It's pretty close, but it won't be exact. So passively traded, which means passively managed, which means that they are not trading it all the time. Basically, what they do is they have their set percentages, and at the end of the quarter or whatever time period they use, they readjust, they rebalance the portfolio to bring it back to what their original percentages were. Because look, say you have a bunch of stocks in there, like one's Apple and Tesla, and they're all supposed to be like 5% each, but Apple and Tesla take off. Well, their value is going to be bigger. So they may be like 5, 6, 7% of the portfolio, which violates the rules. So at the end of the quarter, they'll rebalance and sell the Tesla and Apple to bring everything back to where it was. When you buy an ETF, it's a one-time issuance of shares and they trade in the secondary market. Now, as far as normal investors, that's the truth. There is a way for really rich people to get their own shares printed for them if they buy the portfolio in the same percentages, but that's not on this test. So we're going to just go with one-time issuance of shares. I can't speak. Trade it in the secondary market. You buy it at the ask, you sell it at the bid, you pay a commission. Now, both closed end, open end, both closed end, ETFs, and ETNs, you can buy a margin, you can sell short because they trade. We haven't got DTNs yet, but just know all three of those things you can do. Anything that's traded in the secondary market is on this sheet can be bought on margin, can be sold short. Okay. You can buy these and sell these. You buy them at the ask, you sell them at the bid. Very active markets, very tight spreads, all that stuff. When you buy shares, you pay a commission. When you sell shares, you pay a commission. That's what it is. You're paying a commission on both sides. Unlike an open end, where you just pay the sales charge when you enter, or if it's a B shares, you pay when you leave. But you're really only paying the sales charge, their version of a commission, on one side, either going in or going out. They do not have to distribute 90% of their income. So they're very tax efficient, like common stock, right? So tax efficiency doesn't mean tax-free. It means efficient. What does that mean? That means that you're not going to be paying a lot of taxes on it. Because think about it. If you buy an ETF now and it grows over the next 20 years and it pays no dividends, you haven't paid a damn dime at all, okay? You haven't paid anything, no taxes on this at all. And then when you sell it, you'll sell it hopefully over a year. It's a long-term capital gain, which means you're at 15 or 20% or even less. On the other side of this, on the dividend part, so open end and close end, they pay 90% of their income. It's always going to be, if it's the dividend part, it's always going to be ordinary income. But an ETF, if they distribute it, that's going to be tax efficient. That's going to be possibly taxed at the lower qualified rate, which is the 15 or 20%. But they normally don't pay a lot of dividends. For the most part, you're buying it for the appreciation, which makes it tax efficient. High transparency. It's very high transparent. You can basically see not the actual what positions they have, but the target percentages, okay? So you're trying to do it at the target percentages, okay? So we're going to have an ETF and it says, okay, 2% this, 2% that, 4% this, 4% that. It is straight across the board. That's the target percentage. That's what they're aiming for, okay? Now, doesn't mean they'll always get that. So remember, I said shit moves up and down, so they'll rebalance to that at the end of every quarter. So you have an idea of what they want and what they're going to bring it back to. It doesn't skew too far from that, but that's what it is. No liquidity risk. They're super actively traded. Some of the more popular ones are more active than mutual funds, are more liquid because think, like I said before, market's up at noon and you see it starting to turn to drop a little bit. You want to get out of your position. If you sell a mutual fund or an open-end fund, well, you're not going to get your price to the end of the day, and the market could have tanked by then. Whereas ETF, you're out. You sell it at noon, you get a noon price, just like a closed-end fund. You buy it at 11, you can sell it at 11:02 or 1101, whenever you want. So you don't have to hold on to it. You don't have to wait for your price. You find out right away. Lower fees. Why? Because they're not actively managing it. They're just passively managing it. Basically just sitting on it. And at the end of the quarter, they do a rebalance. That's all it is. And what their biggest risk you have is market risk. The market risk is a risk that the market crashes. Now, the good thing about ETFs is that you can go narrow base, you can go wide base, you can just do like a certain small index. All of them, you can really do this, but the ETFs, they're really aggressive about what they let you do and not do, meaning they have a lot of choices. And you don't have to buy from one issuer. There's lots of different issuers of ETFs, and they're really good. I love them. They're my favorite thing. Now, the thing about ETFs is, and I could have put in here, you can buy leverage ones, which means they move more, right? They'll like you buy a 2X. That means if the index you're tracking goes up by 10%, they'll go up 20. And if the index goes down by 10, they'll go down 20. You can buy an inverse where they just move opposite, and even inverse leverage. So regular ETFs, regular plain vanilla ETFs are good for long-term investing. Inverse and leverage or inverse leverage, any of those are for day trading only because they reset every day. So it's not really good for long-term investing. I've done it, and I had a good 3 years with I had a couple of tech ETFs that were leveraged, and I made a lot of money. Got out, a lot of money relative to my poor ass, but then I went back in because I thought I was smarter than the market, and I got my ass handed to me. So because I thought, oh, it's going up, but once the market is volatile back and forth, those leverage kill you. Okay. Now, the last one, ETN. Remember, ETN is a debt security. They don't actually have a portfolio. Closed-end funds, open-end funds, and ETFs actually own the assets, okay? So there's not really default risk there so much because they own the shit. If the issuer fails, they'll sell the securities, and hopefully you'll get your money back. No guarantee, but you're more likely to because they own the securities. ETNs are considered debt. And think of it this way. I have an ETN. You lend me money. You lend me $1,000. I'm going to say I'll give you $1,000 back in 30 years. It's debt. That has a maturity date. But I'm going to say I'm going to give you back your $1,000 in 30 years, plus or minus whatever the index we're tracking is. So let's say I do the S&P 500. We track that for 30 years. Maybe it's up 4,000% over this 30 years. I'm going to give you back your money plus your 4,000%. That's an ETN. Now, in reality, doesn't actually happen, but in theory, it can actually be negative. So you can actually lose money. So that's the problem with that. So first of all, there's no portfolio. It's senior unsecured debt. So remember, it's debt. So I issue the bond. I don't actually own the shares. I'm just tracking it. I mean, I may do it, but I'm using that money for some other thing. And then I'm just paying you whatever the index paid over that time. I issue shares one time, and on a day-to-day basis, you probably couldn't tell the difference between an ETF and an ETN. But an ETN is a debt security. So you have default risk, okay? We'll get to that. When you buy and sell it, you pay a commission. It trades in the market. Easy stuff. There's no distribution. So that's, I guess it's tax efficient too, right? So if you buy it at 50 and then you hold it to maturity and you sell it for more than you paid for it, you're going to pay capital gains. And if it's more than a year, lower tax bracket. So it's sort of efficient also, don't you think? Because you're not paying anything during the life. That's a problem with open-end funds, closed-end funds. I'll even throw REITs in the bucket, that they're not tax efficient because you're getting paid every year. So you have to pay taxes on that. There's no way the IRS is giving you a break. Even if you reinvest the dividends in the closed-end funds, open-end funds, and REITs, you're still paying taxes on it. They track an index, so you know what the index is. They don't actually own the portfolio. They're just tracking the index. Like I had a FANG one, Facebook, Amazon, Netflix, Google. It was even Apple, I guess, right? So it was tracking that, and I did well for a while when they're going up and down, but they don't actually own the shares. They just track it. And both ETFs and ETNs, even though they're longer term products, you can buy them, sell them. They're going to kind of move with the index that you're tracking. So you can kind of just offset and you can buy shares. And if the index goes up, you sell it, you make money. They're pretty close. There's always a little bit of tracking error, but they're pretty close to what the index is going to track. So you don't have to hold the shit to the end. You have some liquidity risk because you're kind of new, right? And they're not really the thing. So on this exam, you're not really going to sit there and say, oh, by the way, first thing you should do is an ETN. Almost every other security would be better because think about it. Most people people in the business don't even understand them. So imagine trying to tell grandma or grandpa what an ETN is. So an ETN is more for a sophisticated person looking to diversify their portfolio. Much lower fees. Because again, they're not managing a portfolio. There's no guy living in Greenwich going, "Hey, I think Nvidia is a good one today," and they buy it and they whatever. There's nobody doing that. They're just tracking a damn index. Here's the problem with ETNs is that they have market risk, but the biggest risk is credit risk because it's unsecured debt. So if I issue shares of an ETF and I go bankrupt, technically there's a portfolio there that can be used to pay you off. If I issue an ETN and I go bankrupt, you just get in line with every other creditor and hope I have enough money to cover you. So that's the problem, that the ETNs have credit risk first and foremost. So if you see track and index, credit risk, default risk, debt, there it is. It's going to be ETN. So this should help you a little bit. This is probably something you could probably write down. Again, way too fast rundown. And I use the word traded versus managed, but we can figure it out. We're big boys and girls. This should help you a little bit. Again, it's not an all-encompassing thing. This is just so you can see the differences between them. And it's most of the big differences, okay? About the thing that scares everyone. We're talking about the big kahuna, not options. Big old annuities, okay? We're talking about annuities today, fixed and variable. So let's get a move on. Okay, so let's talk about annuities. Annuities are retirement plans. Okay, so they're a retirement plan. They're not the best. You should not do annuities because they have a lot of fees until your 401k is capped out. Your IRA, you have insurance, you have a 6-month thing, and a lot of other shit. If you have all your retirement plans, everything set away, your life insurance, 401k, IRA, everything else capped out, where you can't put more money in, then we can think about annuities. Now, in theory, annuities are great, okay? But in practice, they're not so great because there's a lot of fees and taxes, not taxes, but a lot of fees that come out of it, a lot of rules. So let's just say overall 10,000-foot view. Annuity is a retirement plan, non-qualified, which means the money goes in after taxes, but it does grow tax deferred. And then when you annuitize, you get paid for the rest of your life, so you'll never run out of money. Sounds awesome, but there are some issues. So let's get into it and see what happens. First, we have to talk about that it does grow tax deferred. It's non-qualified. If they don't say anything to you, assume it's non-qualified. What does non-qualified mean? It means it's after tax or gross. Remember, qualified or unqualified, it's about the contribution for the most part. And then the growth is always going to be tax deferred. It's just that when you take the money out on a non-qualified, you only tax on the growth part, not the part you put in. Or a qualified plan, you would tax on every penny because it's never been taxed. Now, they don't really talk about fixed annuities too much on the test, but we have to talk about the two of them. So a fixed annuity versus a variable annuity. A fixed annuity is not a security. A variable annuity is. A fixed annuity, everything is fixed. The amount of money you're putting in, the growth, and then when you get paid out, the payment is set. So you don't really have any market risk at all because you know what you're getting. It has a guaranteed payment. You put in your money, it grows at this rate. And then what happens is when you annuitize, here's your payment. That never changes. There's issues with that, right? Because if you're getting paid the same amount of money every month for 30 years, in the beginning, that's great. But then inflation kicks in, right? And then all of a sudden you're $400, $500 a month is not buying as much. So that's a problem with fixed annuities. So if you have a fixed annuity, because I'm not going to go into it other than right now, fixed annuities don't have any market risk because you're not risk of not making money. But you have inflation risk because you're only making a set amount of money and it's not growing. So that's about as far as I'm going to go with fixed because nobody gives a shit. Okay. So we're going to talk about variable annuities. Variables are more fun in theory. So when you put money in a fixed account, a fixed annuity, it's in the general account. When you put the money in a variable annuity, it's in the separate account. Separate account is where your money's at risk. And what happens is in the separate account, there are sub-accounts. You can choose where you want your money to go. So in a variable annuity, you go, look, here's my separate account. I want 20% in this, 20% in that, 30% in that. I'm not going to do the math. But the point is you can say, oh, I want conservative. I want this kind of mutual fund. Remember, you're not investing in the actual securities. You're investing in the mutual funds, okay? And you determine your risk based on what kind of mutual fund you invest in. So that's where your money goes. All your money that you deposit is put into sub-account or the separate account, which is then put into sub-accounts. Now, there are different types. So you can put the money in lump sum. If you do that, okay, if you do lump sum, you can do anything you want. You can do a deferred annuity where you put it in and let it grow for 20 years and then start taking it out. Or you can do an immediate annuity where you put it in and then you start getting paid the next month. and then you paid for life. Remember, in a nutshell, annuity pays you for life, but we'll get into the details. Again, immediate annuity is if you do a lump sum, you can do an immediate annuity where you get paid right away, or you can do a deferred and wait. If you do a contract plan where you're putting money in every month for 20 years, you can only do the deferred. You can't do immediate. Because, I mean, think about it. How can you put money in and take it out at the same time? Only the government can do that. Okay, so let's get into how this really works. So we have two phases. We have the accumulation phase. Let's hope I can spell it right. Accumulation phase, and that's the pay in, and then we have the annuitization phase. Annuitization phase, that's the payout. So let's make it easy. So pay in, pay out. So you're getting paid. Okay. That makes it simple. Okay. I hope this is fucking recording. Okay. Now remember, it's non-qualified. So this goes in after tax. And then on this side, you're taxed pretty much on the growth, on the way out. Taxed on growth only. Growth. What's the word is that? Growth only. Okay. So let's say you decide to put, oh, that is ugly. Boom. Let's say you decide to deposit 20 grand. Now remember something. There is no limit because it's non-qualified. There's actually no limit to how much you can put in. You can put $1 million in there. If you win the lottery, and you want to make sure that you're paid for life, it's kind of weird, but you can just do this and put your money in and then start getting paid. Okay, so you can put the money in. Remember, it's after tax. It has been taxed. So there's no limit to how much you can put in. You can put it 200 grand, 20 grand, $1 million, 10 million, whatever it is. The IRS doesn't care because you've already paid taxes on it. So they don't give a shit. Now you put the 20 grand in and you're invested in the sub accounts, a separate account, the sub accounts. You're choosing where you want to go. Now the money goes in and it grows up and down and up and down. But let's say after 20 years, it's now up at 100K. Put the dollar sign, 100K. Boom, that's what we have. That's great. We put in 20, it's now 100. We haven't paid a dime in damn taxes yet at all because it's going tax deferred. Let's put in here, tax deferred. No taxes on it yet. But now when you want to take it out, if you decide right here at 100 grand, you have a bunch of choices. You can say, you know what? I just want to withdraw the 100. Well, that's fine, but you're going to pay taxes on this 80 grand. And if you don't take it out a lump sum, they do what they call LIFO, where LIFO is last in, first out. So you're going to start here and work your way backwards. Okay. So what happens is you say you take out 20 grand, that's taxable. You take out another 20 grand taxable. Once you've taken out 80 grand, then you start eating into your principal, which is not taxable. That's LIFO. Now, to be fair, you can do this anytime, but if you do it before you're 59 and a half, you will pay a penalty, 10% penalty on top of your taxes, and possibly surrender charges for the annuity because they want your money in there. They might say, listen, we expected 20 years. You're only putting it for 10. We're jacking you for a little bit. Okay. Now, if I want to annuitize, I don't have to be 59 and a half. I can be any age I want. I can put the money in when I'm 25 and at 26 go, you know what? Annuitize me. Totally fine. Okay. There's also a death benefit. Okay. So the death benefit is only on this side of the line. Okay. The death benefit is only on the accumulation side of the line. Okay. So if you die before you annuitize, okay, so I'm getting on my bus, I'm going to go annuitize it. I'm driving in my car and bang, I get run over by a bus. Then I die, obviously, because a bus is bigger than my car. My family will get the 100 grand, my money. And the good thing is they have a minimum. So let's say, so they get the greater, they get the 100 or what I put in. So let's just say in my variable annuity, I mean, it's a really bad picks and I lost money and it's only worth 18. They will still get 20. Well, I thought there was more to drink in there. That is really depressing. So now, the death benefit will give them that money. They will get that, boom. Now, they do pay taxes on it. They will pay tax on everything above 20. Because usually when you die and a security happens, they step up your cost basis, not this. They do not step up the cost basis. So your family's going to owe the money on everything above 20. So they will owe taxes on 80 grand. But let's not be morbid. Let's get out of the death benefit thing. Boom. Now we have 100 grand. In cash, because that's what it's worth. And now remember something, when we buy into this, I should have said this, when you buy into this, what you're doing is you're buying what they call accumulation units, okay? and you buy them at NAV plus a sales charge, just like a mutual fund, because this is covered by the Investment Company Act of 40, we're good. Now, what you're going to do is you go, well, you know what? It's time. I'm going to come over here and annuitize it. So I bring my 100 grand over here. They sell the accumulation units and they buy annuitization units. Now, the thing is, once you buy the units, that number is set. It doesn't change. I see the vendors ask the question. I don't really think the test goes into that, but bring it up anyway. Now, what's going to happen is you have the 100 grand and you could take the money and walk away. That's totally fine. But you want to annuitize where you're paid for life. So they're going to, depending on your choice. So let's say we choose what they call straight life or life only. Okay. I'll even say just here, it'd be a little tricky, life only. Okay. That means you're getting paid only until you die. And that's the magic of the annuities, is that you're paid until you die. You cannot run out of money. Once you annuitize, you can't change your mind. It's stuck, but you're paid for life. If you live for 150 years, they got to keep paying you. They have to. It's just part of the contract. So if you choose straight life, that's going to be the highest payout. Okay. That's the highest payout. And we'll say, okay, so, and then this is what they do. They look at your lifespan, like at me, say I turn 60, they go, you're fat, you eat horribly. You're going to live for another 20 years. I'll take it. Okay. So let's say they think I'm going to live for 20 years. Yours, is it like Norwegian for a year? 20 years. So 100 grand divided by 20 years, that is going to be 5K a year. 5K a year divided by 12. That means I'm getting, we'll say it's 416. I think I did the math once before, so I remember it's $416 a month. So that means I'm going to get $416. Now, let's not assume growth or anything, but let's just say right now, I'm planned to get $416 a month until I die. Fair enough. But here's the problem. If I then die, then the insurance company keeps the rest. So if I get one payment, remember, this is them paying me $400 a month. I've already paid in. Now they're paying me $400 a month. Say 2 months from now I die. They've only paid me out $832. In this scenario, they keep the 100 grand. They keep the rest, the other $99,200, whatever it is. They keep that and then they're done. I'm out. My family gets nothing. Okay. That's straight life. That's highest payout because it's the highest risk. But remember, here's the other thing. If I live beyond the 20 years, okay, they pay me for 20 years. If I live beyond the 20 years, they have to keep paying me this or whatever the number is. Great. Okay. That's awesome. So I cannot run out of money. That's why I like this. So that's one choice. Another choice is joint and last survivor. That's like a couple, like 2 people, 3 people, whatever it is. And they will pay until the last person dies. So the payout will be less because they're going to use the one with the longest lifespan plus other numbers. So maybe that, I'm again making numbers up, that'll be like $350 a month maybe. But again, they will pay until all of us die. So if I part of it, if I do this and then I die, whoever else I'm part of will keep getting paid until they die. As one of my students said, they call it last to die, which is a little morbid, but it is what it is. Now, the other one is, everyone screws up, life with period certain. Life with period certain. That means they're paid for a minimum number of years, but it is still a goddamn life annuity. Don't forget that. You are paid until you die. That's the point of annuities. You are paid until you die. If you decide to do a limited withdrawal, say for 5 years, then it ends after 5 years. That's not an annuity. The annuitization part is where you're paid until you die. But what they do here is they put a set number of years that they will pay. So say we do 10-year period certain, okay? That means if you live for 4 years, they're going to pay your little chickadees or your beneficiary for another 6 to finish out the 10 years. But if you live beyond the 10 years, they keep paying. So they will pay you until you die. But again, since the risk is on the insurance company that they will have to pay you for 10 years no matter what, maybe it goes down to 325 or something. Who knows? I don't know the numbers. Now, the fourth one, I've never really seen a lot of questions on. They have a unit refund annuity. That means if you die before you've gotten paid out the whole 100 grand. So that means if you get paid out before you've paid out the whole 100 grand, they send the rest to your beneficiaries. That one, I have no idea how they make their money on that, but whatever. So that's the four choices of payout. So you can choose it. There are other ones, you can tweak them, whatever it is. but that's your choice. Now, remember something. Once you annuitize, you can't change your mind. You can choose what you invest in with your payout, in your separate account, but you can't change your payout choice. If you choose this and then you wait, I don't want to do that. You want to change to that, you can't, you're stuck. Okay. We okay with this? This is kind of the basics of, we're going to go into the payout changes and all that, but I want to make sure we understand that this, again, you're putting money in, it grows tax deferred, then you get paid, and then you get paid for life if you annuitize. The problem with this is there are some problems. One, there's a lot of fees. So there's a thing called mortality risk. Mortality risk is that you're just going to keep living and they have to keep paying you. So somehow they factor that into your payments and they reduce your payout by that a little bit. Not a big amount, but it's there. Then there's expense ratio. The expense risk is the fact that the cost of running this plan will go up and up and up and up over the years, but that's not on you. Again, that's on the insurance company. So they owe that. But again, they take a little bit off the top to offset that risk, because insurance companies are all about offsetting risk. So that goes in, that comes out of your end, but it's fine. I mean, that you're good on that. Okay. So remember, on a fixed annuity, you get a set payment no matter what. So the insurance company takes on the market risk, but you have inflation risk. But here we reverse it. They don't have inflation risk or anything, but here's what happens. You're going to do this, and we're going to go into the variable annuity where your payment is invested in the separate account. So that money will go up and down based on how your separate or sub accounts do. So you're taking on the market risk, the insurance company isn't. So let's get into it. Okay, so here we are. You finished up with 100 grand. We're going to use AIR. That's a new one. So AIR is the assumed interest rate. It's not a benchmark. It is a benchmark. It's not a guarantee of anything. It's a benchmark. It's basically what the insurance company thinks they could earn if they didn't try. Very conservative investment. Okay. Now that's your benchmark. If you beat that, your payment goes up. If you lose it, if you miss it, your payment goes down. So let's say in January, your first payment is $416. That's what we figured out. And let's say during that month, you earn, your separate account goes up 6%. Again, I'm just using numbers. You would never have this much in a month, but say 6%. That means your payment in February will rise to, like, I don't know, making it up $450. Again, these are not mathematical numbers. You get $450. Now, why did it go up? Because your return is higher than AIR. That's it. Now that's good. Now remember something, your payment is based on the previous month, but your return is based against AIR. So let's say the next month we do 5.5%. Now that's less than the previous month, but it's still higher than AIR. So this payment will go up from here. So maybe it'll go to, like, not a lot, maybe it'll go up to like 455, making it up. Now let's say this month you earned 5%. Okay, let's compare. Well, you earned exactly the same as AIR. So that means you're going to do the same. So over here, we're going to do 455 again. Doesn't change. Okay. Now let's say this month you earn 4.8%. Now let's compare it. 4.8. Well, that's less than AIR. So your payment's going to go down. Now remember, your payment's going down from this. This one doesn't matter anymore. This is your world. So maybe your payment goes down to like 450. And then maybe the next month you do 4.9%. We compare that to AIR. Boom, that's still less. So our payment's going to go down again. So that's how it works. That's how the AIR works. Remember, it's a benchmark. It's not a guarantee. So basically, keep in mind, one, you compare your return in the separate account, not in the market, in your separate account, with the separate accounts versus AIR. If it's better, your next payment is higher. If it's the same, your next payment does not change. If it's less than AIR, your next payment goes down, and on and on and on. So technically, if you earn 5.1% every month in this case, your payment will go up every month. If you get 4.9%, your payment will go down every month. Okay, I'm not done. We got more to do, but this is like the function to this. Let's get into it. Now, taxable. Remember something. In our scenario, we put in 20 grand and we grew it in 20 grand and it grew to 100. So that means 20% of our plan is tax-free now because it's already been taxed, return of principal. And then 80%, which is the 80 grand, right? I did those numbers on purpose because I can't fucking add. 80% is going to be taxable. So they do that here. So your payment, each of these payments, you don't have to do the math, will be 80% of it will be taxable and 20% will be tax-free return of principal. So we can do that. Oh, I don't have the calculator, so I'm not going to do it. But so I guess we're screwed. But there you go. So that's how the taxable portion goes. And every month it'll change. Every month it'll be 80% of this and 20% of that forever until you die. Okay, so let's talk a little bit more about this stuff. So as far as suitability goes, right? So as far as suitability goes, variable annuities are for people who don't want inflation risk and they're a little on the younger side, like maybe under 60, they can handle the risk of the market fluctuations. Over 65, you probably want to be more to the fix because they can't ride out the bad years and stuff like that because they're on the older side. If you see elderly, think fixed. If you think middle age or younger, then think variable because they can handle it. Okay. Remember a couple of things. So whenever we do an annuity, we have to get principal approval. I don't even know how many days it is. Usually it's like 7 days. Yeah. So after you sell an annuity, you have to get principal approval within 7 days. Usually they send it to the principal at the OSJ, Office of Supervisory Jurisdiction, not fucking FINRA. You're sending it to your Office of Supervisory Jurisdiction, like your main office. Okay. That's the big one. Okay. So now, okay. So a couple more things on this. One, while you can't, it's not prohibited to buy a variable annuity in a retirement account, it's kind of like frowned upon. It's like a red flag. There better be a good reason for it because, I mean, you don't put a tax deferred thing in a tax deferred account. It doesn't really make sense. I mean, there are people, there may be reasons to do it, but the point is it's kind of like a red flag. It may not be bad, but it, like, hey, take a look at me, make sure I'm not doing anything wrong. Also, if you want to exchange from one annuity contract to another, like from one firm to another, there's a thing called the 1035 exchange. You can exchange annuity for annuity. The problem is it's fucking expensive. So if you do it on a period less than every 36 months or every 3 years, it's going to be a problem. They're going to basically think of you as a churning or being unsuitable. So if you're going to do that, make sure, don't do it. But if you're going to do it, make sure that it's at least 36 months in between exchanges or they're going to think that you're fucking your customer. Okay, thanks for listening. That's variable annuities pretty much. That's as much as you probably need to know for the test. You can make sure you read the chapter 100%. But look, if you like what I'm doing, like, subscribe, share this shit, tell your college professors. Let's go. Let's tell the people you work with, tell your bosses. I'm trying to get it out there. I'm trying to give back. Okay. I'm trying to give back. And because not everyone can afford all the books. Not everyone gets, some people get stuck with AD Banker and Exam FX and they're fucked. So at least this can help bridge the gap between the lack of knowledge and passing the fucking exam. Equity indexed annuity. Okay. So that's easy stuff because it's a fixed annuity, but it acts like a variable annuity in a way because your payments or the growth will adjust based on the market or the index that it's tracking. But there's some features to it that make it look like a variable annuity, but there's other features that make it a fixed annuity. Like you can't lose money, they have a cap on how much you can make, and you don't get the whole thing, you get a participation of it. So let's get into it. Okay, so the equity index annuity has a couple features that makes it like a variable annuity, but it also makes it much like a fixed annuity, so you can't lose money. So you have some principal protection here. So here's what happens. Let's say we start with 100 grand. What they're going to do is, these are the rules, which we'll go over, but every year it resets. So whatever money we have at the end of the year, we carry that to the new year, and all the money's based on that, the interest rate, the returns, all that. So let's do this. So we start with 100 grand, and our equity index annuity, EIA they call it. And the reason they did this, I think they did it because the variable annuities were popular. So they realized that people who don't have a 6 or a 7 can't sell variable annuities. So they made this, which is still not a security because EIA is not a security. So people who just had life and health could sell it. What happened was people of the 6 and 7 could sell variable annuities, which are really popular, rip-off, but popular. But the equity index annuity came in to let the people who couldn't or weren't licensed or sponsored to take the 6 or 7 still participate in the game. So here's what happens. One, they put a participation rate. That means whatever the index does, you will get that X percentage of. So in this case, you're getting 80%. So if the index goes up 10%, you'll get 8. If it goes up 20%, you'll get 16. So that's what your return will be. They have a participation rate. Sometimes it's 90, sometimes it's 80, sometimes it's 95, depending what it is. We also have an interest rate cap of 12, which means no matter what you do, you will never get more than 12. So if you earn like 18, you're going to get, say you're in 20, you're going to get 16, but that doesn't work. So the max you'll get is 12. We'll go through that whole thing. Interest rate cap of 12, and then we have a floor of 1, which means you can never make less than 1%. It may be 0, Some of the vendors don't tell you. I think Past Perfect just makes you assume that it's going to be 0 without telling you. So remember that there's always going to be some sort of floor, whether it's 0, 1, 2, whatever, means you can never earn less than that. So let's get going. So we start the year with 100%, and then the index goes up 18%. Now, the problem is we have a cap. So let's bring out the handy dandy calculator, if we can ever get this thing working. I feel like I'm 400 years old. Okay, so we're going to do 18 times 0.8%, and that's 14.4. But that's more than the 12 cap, so we earn 12%. So now you can do this. You can do 100 grand times 12% and then add it. I like to do it a little quicker. I just put one period in front of the percentage. So I'll do 100,000 times 1.12, the 12%. So I get 112,000. What that does is the one period in front of it puts the 100 grand into the calculation. Just the way I do it because I'm lazy. So I'm going to put it here. So now we went up 12% because that's our max. We can't earn more than that. So we now have 112,000 at the end of the year. So now it resets to start at 112. So over here, we're going to put here 112 grand. That's our next year. So let's put it 112,000. Now the index went down 5%, which sucks, okay? But remember, we have a floor. We can't earn less than 1%. So we're going to earn 1% on our money. Better than losing money. It's not a great return, but it's better than losing. So we're going to do 112,000 times 1.01, which is that. So now we have 113,000. We'll put it over here. Our new thing with an extra 1% is 113/120. That's at the end of the second year. Boom, boom, boom. We okay with that? I like that. Now, we end this year and we start with a new one. So now we're going to go over here. We start this year at 113/120, and this could easily be on the 66 also, so remember that. So we're going to cover that. 113,120, that's our new number for the year. So now we move forward. We earn the index went up 9%, but we don't get 9%, right? We're not going to get 9, we're going to get 80% of that. So we're going to do 9 times 0.8, or 80% if you want. That's 7.2. So now we're going to earn 7.2%. So to make it easy, I do 120 times 1.072, and that gives me 121,000. Let me write it in so we have it. 121,264 cents, whatever it is. So that's our ending value. So we see how this happens. I start with 100 grand. I start with 100. I earn, the index goes up 18, but I don't get to make that because I have a cap of 12. So I only make 12%. So now I'm at 112,000. Then I take that over here. My new year starts at the big higher number, whoopee. But the index drops that year. But I don't care because I have a floor of 1%. So I'm still going to get 1% of my money despite the whole world dropping by 5. So now I'm going to get 1%. So I'm now at 113,120. Boom, let's slide over. So now we do the new year, 113,120. We earn 9%. We're not going to get all of that because you only get 80% of the return. So we're going to get 80% of 9. That gives us 7.2%. Boom, we're up to 121,264. So that's our final number after 3 years. Very easy, not hard. It's definitely going to be on the 66.
This is what a REIT is. It's a package product. It's like a mutual fund full of real estate. So it's like a mutual fund full of real estate. Basically, here's your bottle. You can't see it. It's filled with real estate. And you're buying shares of the bottle or the shell, not specific pieces of property. So actually that worked because I would probably pick the worst property in the world that would lose money. So in this case, I'm buying shares of this REIT that has hundreds and hundreds of properties in it. So what happens is I'm diversified. So again, I'm going to say basically a million times because that's just stuck in my head. If you buy a REIT, you're going to buy a package of properties. So what happens is, I'm trying not to cough. Another advantage is it's much more liquid, right? So think about it. If you buy into a piece of property, say I bought a house down there or a building, a property, and I was going to rent it out or whatever it was, or flip it. I buy that, say it didn't work. It could take me years to sell that shit. But I buy a REIT, it trades on an exchange. So basically I can just buy it. And if I go, an hour later, go, you know what? I don't want it. Boom, I just sell it. So again, a REIT is like a mutual fund that holds real estate. There are some rules about what they have to do to be considered a REIT. First of all, it has to be a company, right? It has to be a taxable entity that at least 75% of its assets are in real estate. At least 75% of their gross income has to be from real property, mortgages, financing, stuff like that, basically from real estate. They have to pay out 90% of its income to dividends every year. So that's a thing. The mutual funds and REITs, that's one thing they have in common, that they pass through 90% of their income every year to the investors. Now, why is that a big deal? Well, if they do that, right, if both mutual funds and REITs pass through 90% of their income, they only pay tax on the 10% or whatever they don't distribute. They can do as much as 99. And the reason that's good is because if you have a corporation, think about this. If you have a corporation and they make $1 million, they're going to pay taxes on it. And then they're going to kick out a dividend. And then you're also going to pay taxes on it. So it's double taxed. A REIT or a mutual fund in this case, if they pass through 90% of their income, it's not that 90% has never been taxed. So you're actually getting more money up front. Now let's talk about different types. So what are the different types of REITs? Well, there's an equity REIT. They make most of their money or income from like rental or flipping houses or some sort of operating income real estate. MREIT or a mortgage REIT provides financing for income producing real estate. They make the money off the interest. Then there's public non-listed REITs or public non-tradables. They are registered with the SEC, but they don't trade. Okay. So they are registered with the SEC, they don't trade. And then there's private REITs are like private placements. So equity and MREITs, which are registered, they're very liquid. In and out pretty easily. And you can buy them on exchange, sell them short, buy on margin, all that stuff. The non-listed ones don't trade, so there's no liquidity there. It's a little harder to get into. And they probably have more strict guidelines on who can buy. Whereas a regular REIT, this gives normal people like us the ability to invest in real estate. We can look like Grant Cardone or whatever, and be a millionaire, invest in real estate. Well, we can do it in the form of a REIT. But a recap, it's like a mutual fund, it isn't one, but it's like a mutual fund. It's a packaged product, invest in real estate. They have to have at least 75% of their assets in real estate. 75% of the income has to come from real estate, and they have to pass through 90% of their income. For the most part, if you just see the word REIT, it's tradable. They trade on exchange, stuff like that. Now, I hope that helped a little bit. Now, before I get into the DPPs and limited partnerships, let me be a little embarrassing. In a world where real estate's a feat, comes an option that's quite neat. A REIT or a real estate investment trust, a way to invest with fairness and just. It pulls your money along with others to buy and manage real estate with your brothers. From malls to flats and even office towers, REITs hold the keys to these real powers. No need to buy a building whole, just own a share, play your role. As properties earn, so do you. Though rents and gains, your profits grew. So here's the charm of a REIT's embrace. Invest in real estate with ease and grace. A simple way to join the game with REITs. Landscapes, not the game. Boy, that was bad, huh? Make sure, thank God I didn't sing that. Holy crap. That'd have been really embarrassing if you heard me do that little mini stuff. Now, so a limited partnership. Now, again, this is more for the Series 7. If you want more stuff, there's a shitload of details on this stuff. So a limited partnership is like you're forming your own company. Like we have limited partners and we have general partners. So limited partners are they just put the cash in, and general partners run the company. So if you're going to start your own company and you go, you know what, I kind of want money from people, but I don't want them to have any control, you would do a limited partnership. You can have as many limited partners as you want and as many GPs as you want. But the GPs run the company, the limited partnerships, the limited partners don't. So if you start a limited partnership, let's say, well, oil and gas one, or an equipment leasing, or a real estate limited partnership, oh, sounds like a REIT. So a real estate limited partnership is very much like a REIT, but it's not. It's a partnership. So there's some differences. Now, the main thing about partnerships are that all of the income passes through. So like a REIT before, the actual company pays taxes on some of it. Here, limited partnerships, and it's what they call a pass-through entity. So when they make money, they don't pay taxes on it. The partners do. So here's the way I explain it. If say I'm the GP and I have you 4 partners, so I have you 4 of you plus me, because that's how many people watch my fucking videos. So 5 people total, me and you 4 sucker viewers. Now, if I make 10 grand, if the partnership pays 10 grand, say they make 10 grand after expenses, right? So now they have $10,000 and they have to, by the end of the year, they have to distribute all of it to us. So I'm going to get 2 grand, you 2, you 2, you 2, and you 2, like the band, right? Bloody Sunday. So now, so you're going to get the gain. So you now have 2 grand in your pocket that you may have to pay taxes on because the partnership didn't. So what they do is they pass through the gains, all of them, but they also pass through the losses. Now that doesn't mean you owe money, but it's like a write-off, a piece of paper that says, hey, I know it cost me made 10 grand, but your portion of what it cost us to make that money is $400. So you take your $2,000, you subtract your loss or your write-off of $400, and now you only have to pay taxes on $1,600. Now there's a couple rules here. So prior to the 80s, your losses could exceed what you put in, and it was a great tax write-off. Now it's not as good. They lowered the tax brackets, took away a lot of the loopholes. Again, limited partners, general partners. Limited partners drop the cash. They're silent partners. Hopefully, GPs run it. They have unlimited risk. That's another thing. So GPs, when shit goes bad, they have unlimited risk on them, and they're paid less. Limited partners can only lose what they put in, which is great. So again, we got this. So the company makes money. They pay their expenses. They pay their bills. Then they pass through all of the money to all of the partners to split up based on their percentage ownership. And then they also get write-offs or losses, they call them, to reduce what they pay in taxes. That's the advantage of buying a limited partnership. The problem is they're not very active. So like on the Series 7, they'll be called DPPs, direct participation programs. They're not liquid at all. Okay, so not very liquid, hard to get in and out of. And when the rep does it, I mean, think about it. The GP has to let the LP, the limited partnership in, the limited partner in. So when the register rep tells the person, oh, I think you should do a limited partnership, they can't assume that the GP is going to let them in. So they got to hope it happens. You put them in, the GP says yes or no, and then the next day you're in the partnership. And what you will do is you will fill out a subscription agreement. So when you are joining the limited partnership, you do a subscription agreement where you're signing up and you know what you're putting in, whatever. The actual partnership is created with a partnership agreement, and then they actually file the certificate of partnership with the state. So again, so the three forms you have to think about. The certificate of limited partnership is what there's like the form that just says, hey, here's our partnership. Ken Finnan is Great Inc. We've not LP, I guess it wouldn't be Inc. Is filed with the state. Then we have the partnership agreement, which is lists all that. That's the lists what the partnership does and the general partners and stuff like that. And then the subscription agreement is how the limited partner joins. Sorry if this is a little like disjointed. I'm just cuffing it as we go. These are not, men, these are not liquid. So if you're going to put somebody in a limited partnership, you have to make sure that they can, one, kind of benefit from the write-offs and they want the money, and they don't need the money. They have no liquidity needs. I think that's fair. If you have discretion over somebody's account, which means as a rep, you can make trades without permission first. You have to get, this is the one of the few things you need permission in writing before you put them in. So if you put somebody in a limited partnership, you have to make sure that you have permission from them. Even if you have a full discretion account where you can do any trade you want for them, for this is still needed because it's a partnership. And in reality, since it's a partnership, if they run low on money, they can ask for more. And if you don't come up with it, they can take away some of your ownership because they have to give it to someone else. So that's why you need to have their permission so they understand what's going on. Now let's talk about this again, high level shit. It's a Sunday night and I'm bored and Billy asked me to do something. So I decided to do it. Billy Dixon, you're a bastard. Now, I love you though. He's seriously, Billy is like a really great, he's always helping people out. It's amazing. He's an amazing guy. He's going to do well in his life. Now, back to this. So there's three main types of DPPs that we think about for the test. So there's real estate limited partnerships where they invest in real estate. And again, the gains pass through, the losses pass through, stuff like that. Now, when we have raw land, so sometimes they invest in raw land, which you can't do. There's no real tax write-offs for that because it's pure speculation. But think about it. If we buy a building like a REIT in a way, buy a bunch of buildings, the value of the building, because it's man-made stuff, depreciates. So we can depreciate, okay? So we can use depreciation as a write-off, which is a great write-off. Because say you have a building that's worth $1 million, right? And it say it's going to live for, it's going to last for 30 years. That's what the IRS says. You can write off $30,000 a year, even though you're not losing money. I guess that's 30 or so. So if you make money on it, you can write off the depreciated value. You can lower your income by the depreciated value each year, which is great. So remember, man-made shit, you depreciate. You depreciate man-made shit. So that's what real estate limited partnerships, they manage real estate and they pass through the gains and the losses. They're trying to make money. Then we have equipment leasing. Like, have you ever ridden a bus and it goes owned by and then operated by? Well, the owned by is the equipment leasing corporation, and the operating by is the one leasing it from them. So equipment leasing, they're taking the income from people leasing their buses and tractors and stuff like that. And any repairs they do, if they have to do the repairs, becomes a write-off or a loss. Now, the last one, the one that you'll most likely be tested on, is oil and gas. So oil and gas is like, say I'm Hess, I start my own partnership, I bring in a bunch of investors, and I start drilling for oil or whatever it is. So there's 3 types of oil and gas ones that we think about. There's another one, but I've never seen it tested. The first one is wildcatting, baby, wildcatting. That's exploratory. You're drilling where there is not oil, high risk, high reward. Okay, that's high risk, high reward. That's good. Then we have developmental, where we're either buying one that's already found oil, or we're drilling where we know there's oil. Little less risk, little less reward. Then the last one, income, where they actually take a working oil well and they just sell it. Now, remember, this is the greatest write-off in the world. So if you have 100 barrels of oil and you sell a barrel, you can't sell that barrel again. So you get to deplete it. It's called depletion allowance. And with oil and gas, they use percentages. So you will never have to do the math on this, on any of this shit. So if you have 100 barrels of oil and you sell 2 barrels, that's 2%. So you get to deplete it. Oh, so wait a second. So wait, man-made shit is you depreciate man-made shit, and you deplete God-made shit. You know, oil, gas, coal, shit like that. All those things, anything produced by God, lumber, you deplete. Deplete. Now, one thing, if say we do crops as part of our limited partnership, you can't deplete crops because they come back. But lumber may take 30 or 40 years to grow, so that you can deplete that. Let's just recap before I head out of here. Limited partnerships on this test are called DPPs. They're not for the faint-hearted. They're for more people who don't need liquidity, more sophisticated investors. The big thing is that all the gains and losses are passed through the investors. All of them, the gains and losses, the actual entity doesn't pay taxes. They're not liquid. You have to make sure the person can handle the loss. Limited partnerships have limited risk. They can only lose what they invest, and general partners can lose more. One thing I'm going to add on to this. Normally with a capital loss, you can you can offset all capital gains and use $3,000 against your ordinary income. With a limited partnership, the losses can only be used against passive gains. Passive losses can only offset passive gains. I worked with an analyst class, a couple of them, and they asked me to do a high-level review of options on a chart. So we did that the night before they took the test, and they said it was all super helpful. Not so much that they wrote it down as a cheat sheet, but just good in one spot. They see all the option stuff they need, not the matrix. We have the matrix. It's something different. So we're going to give it a shot. Stay to the end and take a screenshot, and maybe that you can print out and put on your wall. I did different colors, like I did green for bullish, red for bearish, and then other colors for just fun. Okay. Woo. Okay. So let's get into it. Let's see how we do. I'm going to turn the screen off so you don't miss anything. My video off. Hopefully that helps. Gets my ass out of there. Boom. There we go. That should make it a little bit more better. Good English. Okay. So here's the deal on this. So we're going to start with the first thing we're going to look at, right? Buy a call, right? See if I can get, I think you shouldn't have anything in front of you, I think. But so if you buy a call, right, it's buy one XYZ 50 call. That's a long call. You're bullish. It's for speculative, and the break even is strike plus premium. Pretty good. Remember, green is bullish, red is bearish. So then we go to the next one down. Buy a put. It's a long put. That buy, own, hold, long all mean the same thing. It's bearish. And look, it's still speculative. You thought I was off kilter. And then it's strike minus premium. Okay. So buy an XYZ 50 put is a long put. It's bearish, strike minus. Buy a 50 call. It's a long call. It's bullish. It's speculative, and strike plus premium. Go to the next one. Sell a call. Ooh, naked. Oh, we wonder where that's going to go. So selling a 50 call is like shorting or writing a call. It's bearish, and you do it straight plus premium. And then we go to the next one. And remember, red is bearish, so it's bearish. Oh, naked, uncovered. That's what it means when you sell an option by itself. It's naked or uncovered. So we're going to sell an XYZ 50 put. It's short, write a put. It's bullish. You're doing it for income, and you do strike minus premium. So let's go over this again. So these these are for speculation. It's white, so you're not going to see it. So I'm not going to even bother anymore. These are for speculative when you're buying options, and these are for income. Whenever you sell an option, it's for income. That's the only reason. So let's jump down a little bit farther. Let's go to the hedging. Okay. If you're long stock and long a put, that's a protective. Or if it's done on the same day, it's a marry put. You're still bullish because the stock rules. And HIP, in my world, HIP means hedge, insure, protect. So if you buy stock and then you buy an option, buy a put, you're doing it for HIP.
HIP, hedge, insure, protect. So I always say buyers are HIP. And since it's buy and buy, it's going to be stock plus premium for the break even. Super easy. Next hedge, long stock, shorter call. That's a covered call. Why you do it's bullish because you own the stock, maybe even neutral if you sell it at this. The strike is the same place you bought stock, whatever. You're doing it for income. The only reason you ever sell options is for income. And this is a covered call. Okay. How do you do break even? It's going to be the stock minus the premium. Remember, I'm right. I put stock in big letters to remind you it's not the strike price, it's the stock. And always remember, stock is cool, stock is it, stock is everything. Okay. Stock is king, stock is everything. Now, those are two of the hedging ones. But remember, I do a covered call for income. Next, short stock, long call. That's a protective call. Now, since I'm short stock, I'm bearish. See, it's red. Okay. And I'm doing it for HIP, a hedge insurance protection. Again, HIP, hedge insurance protection. Buyers are HIP. So when you buy an option with a stock position, you're doing it for HIP. Buyers are HIP. Hey, HIP, who cool. It's for hedge insurance and protection. And again, since it's a buy and a sell, it's stock minus premium. Super duper easy for break even. And these will answer a bunch of questions on the exam. So if you're short stock, short a put, to sell and a sell, well, since you're selling an option, it's a covered put. So let's see this for a second. So if you sell an option by itself, it's naked or uncovered, like it's blowing in the wind, right? It's uncovered, it's naked. But if you have a stock position, so if you sell a call and you own stock, that's a covered call. If you're short a put and you're short stock, that's a covered put. I like that. I think we're on the same page. So if I short stock, short a put, it's a covered put. It's bearish, maybe even neutral if I sell it at the strike, the same place I shorted it, and I did it for income, and it's stock plus premium. Why? Because it's a buy and a buy. So remember, the same you add, different you subtract for break evens. Okay, that's hedging. Let's move on down. Now we're going to the straddle world. I'll do both at the same time. I know, screw it. We'll do both. Okay. Now, long call, long put, that's a long straddle. Okay, long call, long put, that's a long straddle. Because how do you know it's long? Because there's the long. So if they say the word buy, own, hold, long, and you see two of them, it's a long straddle. And what do? You do it for volatility. See, there's no color here because it's not really bullish or bearish. You're looking for volatility as two break-even points. I could probably even write that in there. Now, look what I did here. When you see two options, you have to do something. I can't circle, right? Let me do it in here. So if you see two options, right here, two options, you have to do something with the premiums. Since it's a buy and a buy, you're going to add the premiums. And then you do the call plus the total premiums. And then you do the put minus the total premiums. So if it's 4 and 2, you add them up. That's 6. It's going to be the strike plus 4 and the put strike minus 4. So these are the straddles. A long call, long put. It's a long straddle. We want volatility. There's two break evens, one up, one down. And then then we have a short straddle, which again is a short call, short a put. So remember something, we name things for what they are. So a straddle is either long or short. And why is that? Well, because it's either long and you bought both, or you're short because you sold both. Pretty straightforward. Moving on in. We're going to keep moving. Spreads. Okay, here we go. So it's a long call, short call. Now, I put the heart near the dominant one, right? So the dominant one is the one that drives the spread. So that's why I have the heart next to it. So in this case, long call, short call. If the dominant call, if the buy call is a dominant, then these things follow. But let's get into this for a second. How do I know if a call is dominant? Well, the lower strike call is always a dominant. Okay, so if you have a 35 and a 40 call, the 35 is always dominant on the calls and the longer month. So if it's a longer month, it's always dominant. And on the put side, it's always the higher put or the longer month. So it's always the longer month, the farther away. So it's August right now. It's still almost September. My anniversary is in 2 days. I still haven't bought anything. Honey, hopefully she doesn't watch this. It's right now. Would I rather have an option that lasts until October or December? I'd much rather December. So that's why it's more expensive. It's the dominant. So that's the two ways. So I'm just showing you not how to find the dominant, but if you get the dominant. By the way, if they give you the premium, don't fight it. The bigger premium is always the dominant. Always. The lower call or the higher put or the longer month. Those are the rules. Unless they give you premium, and then it's whatever they say it is. Now, if this is a long call spread, so it's called a debit spread. If you see the word long, own, hold, the dominant tells you since the dominant is a buy means debit. So this is a debit spread. And since the buy call is a dominant, it's bullish. Since it's a debit, you want it to widen and exercise. Remember, dead wives can't nag. Okay. So debit, widen, exercise. And when you do the break even, you subtract the two premiums from each other, and then you add it to the lower strike price. That's what it is. Again, when it's a call spread, you add to the lower every time. Okay. And it's green because it's bullish. Let's go to the next one. Long call, short call. Well, it sounds familiar. But the dominant is the short call. So the short call is either the lower strike or the longer month. Since the short call is the dominant, that's a sell. Short means sell. Sell means credit. So this is a credit spread, and we're bearish, and we want it to narrow. We want it to expire. That means we remember when I say widen or narrow, we want the premiums to either get farther apart or closer together. So that's what narrow or widen means. And expire means I would love it if both options expired. Because remember, I have money in my pocket. So I want it to stay that. I want the money to stay. So if it expires, I keep the money. And again, you subtract the premiums because it's a buy and a sell, and you still add to the lower strike. So in a call spread, you still add to the lower. Pretty straightforward. I try to look at these things like I teach the different way methods. And look, and if you guys want to really have a really revolutionary way, okay, way to look at options, it's a different way. I kind of created a method that's the kind of way I think of them. I'm kind of nuts. So I kind of think of them about break even and everything. And it's really intuitive and it really works. Okay. So that's why I'm just saying, since we're in here, might as well make a pitch for you can buy my options. You can rent my options videos for $20 a month. That's nothing. That's like what, 2 packs of cigarettes. Well, maybe 1 pack of cigarettes. It's one movie with no popcorn or drink, but one movie. Okay. Let's go to the next one. Oh, I surprised you. Long a put, short a put. Okay. So long a put, short a put, that's a put spread. Now look, the dominant is a long put. So that's a debit spread. That's a buy. Buy means debit. So long, buy, on, hold means debit. So long a put spread, since I'm long a put, buying means debit. And if I buy a put, buying a put is bearish. So is the spread. Since it's a debit, I want it to widen and exercise. Remember, dead wives can't nag. And then again, you subtract the premiums, the two premiums from each other, and then you subtract them the higher strike. Pretty straightforward. Now the last one. Long put, short put. I keep saying the same thing over and over again, but it's because the dominant is different. So in the long put, in the first one, in the red one, the long put is either the farther month or the higher strike. And on this one, the short put is the higher strike or the longer month. So and again, or the bigger premium, whatever the bigger premium is, remember you follow that. So this is a long put, short put. This is a credit spread. Since sell means credit, the short is a dominant, that means credit. If I sell a put, I'm bullish. You know that already. And if I have a credit, I want it to expire because I have the money in my pocket. So I want it to expire and I want the premiums to get closer together so I can buy it back cheaper. So understand that. I'm not going to go into the math on this, but if you have a debit spread, you spent the spread. If you want to sell it, you want the spread to widen. You can sell it for a bigger spread for more money. And if you sold a spread, you sold it for the difference between the two premiums, that spread. And then you're hoping it gets narrow and you can buy it back cheaper. Okay. So this is a little chart. Take a screenshot of this. I think it will help. This is not something that you would write on your hot sheet, but it's hard because it's too much. But it's a really good reminder, print it out, put it on your wall. My analyst students, they had me write this down. They were like, oh my God, it's just so great to have it all in one spot. This isn't end all be all, but it really does help with seeing everything in one piece of paper. Okay. So what's a future? You need to have a little backstory first. So I'm a farmer. I have all this beautiful wheat that I'm going to sell in the future. Oh, there we go. I look online and I see in the markets that I could sell this wheat for 50 cents a bushel. All this wheat I could sell for 50 cents a bushel right now. But I'm not harvesting it for another 2 months. So I'm worried that in that 2 months in the future, the price will be lower. So what I'm going to try to do is hedge it. So what I'm going to do is I'm going to hedge it by going into the marketplace and selling a future. What a future is, it's a contract where I'm obligated to sell it at a price in the future. So I'm going to, right now, let's say it's January, I want to sell my wheat in May. I'm going to sell a May wheat 50-cent future. I'm locking in the fact that I get to sell my wheat at 50 cents in May. Now I'm contracted. I can't walk away from it. It is locked in. I have to sell it. And the person who bought it from me has to buy it from me. That's the contract. Boom. He's contracted to buy. I'm contracted to sell. So in May, we have contracts to buy and sell. We're locked in. Now, we don't have to hold it. We can actually undo it. We'll offset it. So if I sell the future, what I'm going to do is, so offsetting it means I get to buy it back. So I'll buy the contract back. So I sold the future for 50 cents. Maybe the price of wheat went down to 45 cents. I buy it back for 45 cents and I make 5 cents per bushel times the bushels times however many I do.
but that's how I offset it. I can get rid of it that way. So again, I'm a farmer. I'm worried the wheat's going to drop. I'm going to sell a future to lock in a price for the next 3 months. If the price goes down and I want to take that profit, I can offset the future by buying it back in the market, like behind me. Now, if I bought the future, I can offset it also. I'm locked in. I go, look, the price went up. Let me sell it and take a profit. I'll offset it, sell it in the market. Hopefully, I'll make a little money. Now, the thing about futures is they're very standardized. They have set contracts. Like, so we can do like pigs, frozen concentrated orange juice, gold, silver, platinum, all these, heating oil, propane, all this stuff. We can sell all these frozen concentrated orange juice, like in the greatest movie ever, Trading Places, with Eddie Murphy and Dan Aykroyd. But what they were trading it. So if you sell a future, you can offset it by buying it back, hopefully at a lower price. If you buy a future, hopefully you can offset it by selling it at a higher price. But if you don't, the joke is that you're going to wake up one morning with 40 pounds of pigs in your front yard. That's probably not going to happen. The thing about futures is that they're standardized, like options in a way, where they have a set number. Each contract is a set number, like gold is 100 troy ounces, wheat is like 5,000 bushels, maybe apples, maybe hogs or a train load or a car load. Those are standardized. And the expiration month is standardized also. But forwards are a little different. They act the same, but they're not standardized. So you can have I want it to be 2,200 bushels.
Here's one that everyone confuses, and I think they make it deeper and harder than it should be. Ooh, Michael, that's what she said. Okay. Now, in life insurance, right? So life insurance, so think of it, the variable annuities pay until you die. Life insurance pays you when you die. I should probably do this right after the annuity video, but I think I will. Now, so again, annuities pay till you die, insurance pays when you die. So there's two main types of insurance. There's term, and then there's whole. So term, you're buying the death benefit only. That's all you're buying. You're not buying cash value, nothing. You're literally renting insurance for a time period, okay? It's cheaper. The reason people do it is why do people rent apartments versus buy a house? It's cheaper, okay? So term insurance is like you buy term for a specific period, like 5 years, 10 years, 20 years, 30 years, whatever it is, and you pay every month. If you miss a couple of payments, they cancel it and you're done. You walk away with nothing. Like if you stop paying rent, you're not gonna you get kicked out, you walk away with nothing but your own furniture. There's no equity, no buildup of value or anything. Now, there are different types of term, but they're not going to go too into. There's rising, there's dropping. That's not this exam. The 65, 66, they're not going into it like that. Understand, you buy term, there's no cash value. When it ends, it ends. You can renew it. A lot of them offer guaranteed renewal. What that means, guaranteed renewal means that you're guaranteed to renew it. So if you buy a 10-year period, guaranteed renewal. At the end of 10 years, you're guaranteed that they will let you renew it, but they don't have to do another physical. Because when you first sign up for insurance, you do a physical, and they make sure you're insurable, and they rate you. Like me, I get a horrible rating. So because I'm fucking fat. And so what happens is you're older, so they're going to charge you a higher rate based on your age. They're allowed to do that. They're guaranteed to renew it, but they're going to say, listen, you were 25 when you did it. You're 35 now. You have a higher chance of dying. We're going to charge you an extra $100 a month, whatever it is. They're allowed to do that. That's part of the renewal. One more other type of renewal, what type of term, is like when you start a job and you fill out the little thing and it says, oh, for $8 a month or whatever it is now, we'll if you die, we'll pay you 3, 4, 5 times your salary. If you lose an arm, that's called group term insurance. It's like a fringe benefit. Fringe benefits are benefits outside the normal, okay? Like commuting benefits, this group term life insurance, maybe access to a lawyer or HSA or FSA stuff. Okay, that's term insurance. Whole or permanent insurance means you're buying into it and it's actually growing value. So it's going to be more, it's a lot more expensive. So like right now, I think I have a term and whole. So my one term is like, say it's $300 a month, right? If I did whole, it'd be close to like 800 or 900 a month, maybe 1,000. But here's the difference. You're putting in, say you put the 1,000 in. The 300 that you would have paid for term is toward the insurance. The other 700 or 800 is going into the general account or the separate account, depending. So the money goes into the account. It's invested, not well. It's going to go at a fixed rate. But if you do regular insurance, you put the money in. Some of it goes to pay the insurance. The rest of it goes toward increasing your savings. So you have some cash value or surrender value. Now let's go through them. If you buy whole life,
The premiums are fixed, they're set. Okay, they're set. And the money you put in grows at a set rate. And then at death, your family gets money. Boom, that's it. Your family gets money, they get paid whatever the death benefit is. So if you buy a $2 million policy, say it costs $2,000 a month, $2,000 a month, say maybe 1,800 of it's going into your general account, and every month you're adding to it and it's growing and it is earning some sort of interest. Not great, maybe 4 or 5%, whatever it is, maybe less, but it is growing at a set rate. So your death benefit is set based on this. Now, the cool thing about insurance is, you should always have it, is that if you make it doesn't matter how many payments you make, but if you buy the insurance and then you die like after like a year, you've only paid in like, 20 grand. Your family's still getting the full death benefit. You don't have to go to the end. It's basically when you die, their family gets payment unless they dispute it or something, which they try to do. There's a bunch of lawyer movies about that. So if you have insurance, you make payments, even if you don't make all the payments into it, like don't equal what you get, your family will get paid when you die. Now, a couple cool things about this. All the insurance you're talking about now, you build up cash value with a minimum rate, and you get paid. Your beneficiary gets paid if you die. Remember, you're building up this cash value or surrender value. You can actually, at some point, when it gets big enough, you can borrow against it without it. So it grows tax deferred. Okay, you can borrow against it, but if you do, you're going to pay interest to yourself, to the insurance company. You're going to pay interest. Now, the cool thing is, in reality, if you borrow the money, you don't pay taxes on it. You do pay interest. If you die, you never have to really pay it back. You pay a little bit, but you don't have to pay it back. What they do is, if you die with outstanding, they just subtract the loan from your death benefit and then pay your beneficiary the balance. So say you have $1 million policy, you borrow 200 grand. When you die, they'll pay 800 grand to your beneficiary. It's a cool little thing. And a lot of insurance people, they're not supposed to, but they sell that as a retirement benefit, right? So say you're 55 years old, you're still 4.5 years from being able to take money out tax-free. So you borrow money from your life insurance just to get you through those 4.5 years. And then you never pay it back. And then it's tax-free money, you get a big lump sum. And then when you die, your family gets a little bit less. Screw them, right? Just take the money out. Now, that's the one thing. That's whole life. Fixed premium, fixed growth, fixed benefit doesn't change. Now they have another one for someone like me. So I have, I guess I'm a small business owner, right? I would say entrepreneur, but I'm not really. I'm really busy from like February. I mean, 12 hours a day, 7 days a week, wait list, all that shit from February all the way till about the second week of December. Then it just falls off a cliff for like a month. I literally, like I say, every December and January, Christmas, I'm doubting my life choices. And then all of a sudden, when I think it's dead, boom, it builds up again. Like now it's March, I'm balls out busy, I have a wait list. I can't even run for costs this year. I have so many. I'm starting at like 10 in the morning. That's why I'm doing this. This is 1 o'clock in the morning. I'm doing it because I was teaching till midnight on a Friday night. What is going on? So now that I just ranted on that, but the thing is, I can afford more from March till November, right? In December and January, I can't afford so much. So they created a thing called universal, where you can adjust the payments. You can underfund it or even overfund it to increase your death benefit. So let's say buy $1 million policy and you're supposed to pay $1,000 a month. I'm making up numbers. They don't care if you pay, they owe you 12 grand. They don't care if you pay it over from March to December or January to December, a lump sum. They don't care. If you make the entire payment, the 12 months worth of payment by the end of the year, we're good. The death benefit stays the same. But if you underfund it, say you don't have enough money and you only pay like 8 grand out of the 12 you owe, then they're going to adjust your death benefit down on whatever basis, whatever formula they do. You'll underfund it, they will adjust it down, and then you can always make it up. But the other thing is, a lot of people, they overfund it. They buy like a $5 million policy, say that they pay 5 grand a month, they put 10 grand a month in or 7 to increase it. So what happens is, if you do that at the end of the year, they increase your death benefit. So your heirs are getting money tax-free, because that's the thing. When you get paid from insurance, it's tax-free. Again, when you get paid from insurance, it's tax-free. Say that again. Paid from insurance is tax-free. Get it in your head. Variable annuities, it grows tax deferred. You pay tax on the growth. Insurance, you get it. If you die, you get the money tax free. Now, if you withdraw it, there's other issues. If you actually withdraw the money versus borrow it, you will pay taxes
on the growth portion. But it's cool. They do FIFO. Remember retirement accounts, they do LIFO. Here, they do FIFO. So the first money you come out is your premiums. Back to this. Now, so universal, you can adjust your payments up or down. Awesome. It's better for entrepreneurs, people who have a not a steady income stream. So they can overpay, underpay when they need to. But it grows at a fixed rate. It's like a guaranteed minimum return. You can borrow against it. And what some people do, which is interesting, if your cash value is big enough and it's paying off dividends, if the dividends being paid off by that policy are more than your premiums, you can just stop paying your premiums and let the interest pay off. You still have the same death benefit. You're all good. The only thing is your cash value won't grow because you're using the growth part to pay your premiums. It's fine. Usually after 7 to 10 years, there's enough growth in there that it'll pay your premiums. Very cool. When I first started, in early 1990, I was going to do it. And he said, yeah, look, usually after the 7th year, it's free insurance. You don't have to worry. It's just paid for itself and you get millions of dollars. So again, whole life, fixed growth, fixed premiums, fixed death benefit. Universal, adjustable premiums, fixed growth, and the payment's a fixed benefit, fixed death benefit. But if you underpay or overpay, you can change it on your own. Okay. The last one, everything I talked about was not a security. Not a security. You don't need the 6 or the 7. You just need the 63 and insurance license to sell these things. This next one, you need the 6 or the 7 and the 63. Okay. This is called the variable life insurance. It's a fixed so it's a variable life insurance. The reason it's called variable is because the growth is variable. The whole and the universal, you put money in the general account. In a variable, you put money in a separate account or a sub account, like the variable annuity. So it's invested in the market. It goes up and down. So let's do it. Fixed premiums. The money you're paying every month into the insurance is fixed. It doesn't change. But the money that's in there, it's invested in the separate account. You can kind of control how risky, how aggressive you want to be. It's going to go up and down based on the market. So hopefully that will actually beat what you would get in the whole or universal. No guarantee. You could lose money. Now, here's the thing. If you put money in the variable account, in the variable life insurance, and it's in the sub account, if it grows fast, then actually your death benefit will be adjusted up because of that. You could actually end up having put more money in your sub account than death benefit, but they'll keep adjusting it up so it doesn't happen. But here's the thing. So say, God forbid, you invest in the market and it goes -5 every single year for 20 years. It sucks. You have no cash value because you put it in and it goes negative. You lose all your cash value. So let's say you have a cash value of 0. It never happened, but it's just explaining it. No matter what, even though if you die, your death benefit still stays. You have a minimum death benefit. No matter what the return is on your cash value, your death benefit is guaranteed to be a number. It can go up. Ooh, you can, see, I need the money. It can go up, but it won't go below a certain number. If you buy whole life or universal, the investment risk is on the insurance company because they have to hit a certain return. That's not your problem. If you buy a variable, the investment risk is on you, the policy holder. Look, I've never seen the loan, like you can borrow a certain amount against your policy and all that. I've never seen a question on numbers. I think they just kind of just know that you can do it. Now we have to talk about one thing that sounds pretty morbid. I mean, we're talking about life insurance, why not? But it's actually not. It's actually kind of interesting. So it's a viatical product, okay? A viatical, what happens is, if I have $1 million policy, and maybe my cash value is like 600 grand, I haven't put that much money in. So I have cash value of 600 grand, $1 million policy. And then I go to the doctor and they go, you know what? You got 2 weeks to live. And I go, and I go, I want a second opinion. He goes, well, you're ugly too. Okay. Anyway, so now, bad joke. You have 2 years to live. And I go, wow, okay. So I go to the insurance company and say, I want to have a bucket list. I want to go to Paris. I want to go to France. I want to Machu Picchu. I want to die on Everest, whatever it is, or just pay the medical bills. They go, sure, we'll give you 500,000. I go, well, my cash value is 6. It doesn't matter. You can only take out 500. But when you die, you'll get your money. So the viatical settlement is this. There's brokers that do this. And a viatical settlement is, I have $1 million policy. They're going to pay me like 800 or 900 grand, maybe more, maybe 950 for my policy. They give me 950 grand. I sign it over to them. And then when I die, they get paid. Now it sounds really morbid, but they're actually helping me out. They're giving me more than the damn insurance company is going to give me. So it works out.
There are some rules on this. One of the big rules is I have to be diagnosed to be dead in 2 years. But if I live beyond that, they keep making the premium payments, but when I die, they get paid. So I get the money, they make the premium payments, and when I die, they get the money. So they make a profit off the difference between what they pay me and what they get. And know that viaticals are considered securities, so you have to be registered to sell them. Okay, so what's a hedge fund? A hedge fund is for rich people, right? Usually you have to be accredited to invest in this, and they're very illiquid, not liquid at all. They're a pooled investment. I mean, they act like a mutual fund in a little way. That's a pooled investment that you invest in, and then the manager buys and sells securities and tries to increase return. Here's the thing, they're unregulated, not in the same way. They have some regulations, but like the IA normally has to be registered, but they're not regulated like mutual funds are. So they can actually do anything. They can buy corn futures, they can invest in property, they can short stuff, they can buy on margin, they can short, they can do a lot of things. So they can take risky endeavors. So that's why it's not really suitable for most people. It's really only suitable for sophisticated investors, usually accredited, who can handle the risk and understand it. So a hedge fund, remember, a hedge fund takes on risky investments and then they hedge it. That's why they're called a hedge fund. They have risky investments and they may find a way to hedge it in an alternative way. But they are risky. They are not liquid. Remember, that's a couple things. So one, they're risky. They do sophisticated strategies that the person who invests needs to understand that. And they're not liquid. Like I know one of my friends had one, and he said, when you want to pull out, you had to let them know, and then you get your money the next quarter. But they can say no. They can go, you know what? We're not letting you out. If you remember from The Big Short, I think Michael Burry, he was running the hedge fund, and everyone wanted their money out in it, and he said no. He wrote a letter. It was a big deal. They tried to sue him. He said, you're not getting your money out because I'm in a very risky, illiquid investment, and if you made me sell it now, we guarantee to lose money. So hedge funds are illiquid, only for sophisticated investors, and they're not registered like mutual funds are. So let's go through this one last thing. It's a pooled investment. They're illiquid. They have increased risk return. Like their risk is increased, but the return should be better. They're not very transparent. Usually can't tell what's in them. There are some tax issues, and there's a lot of fees. Okay, they have very complex tax structures and carried interest and all that, which is not on the exam, so I shouldn't have fucking said anything. But they do have higher fees. They usually charge what they call a 2 and 20. That means they charge 2% of the assets and 20% of the profits. Okay, so you may see that a 2 and 20 means that they charge the asset manager 2% of the total fund and then 20% of the profits. Okay, guys, I think I covered everything. That's investing in vehicle characteristics. Thank you for listening in for this 2 hours of just rambling and all this crap. Thank you very much. Let's go get this test. Don't forget to check me out every Tuesday and Thursday night, 8:30 p.m. Eastern, for my live Q&A. And we also have the Friday night class, right? That Friday night class is a lot of fun. We go over stuff. You can join a membership. It's $25 a month. I mean, really, 4 classes a month for $25. Where are you going to get a deal like that? We're going to get the stylings of me, okay, for that cheap. Then you can get it probably cheaper. So listen, we got this. I'm going to stop rambling. Go wash your hands.